Hey everyone, it's Imran from Options Insight, back with another macro options spotlight for you. Remember, like, subscribe, comment, ask questions. We want to get this stuff passed around so more people learn about options. Okay, nice bounce in stocks yesterday after last week's nerves ahead of CPI today, literally out in 15 minutes. Some squeeze risk coming back, it looks like, as people looking for a bit of a hot number, putting on a load of hedges, things like that. So we do think, people not as concerned about the right tail, which means the right tail might actually be the thing to be concerned about. Commodities were heavy as well. Only copper managing to end up in the green yesterday. Nat gas also struggling, reversing its recent bounce, really struggling to bounce convincingly off these lows that it's made down at $2.50. Vol-wise, vols were lower on the rally. We can see here down a vol point in NASDAQ and S&P. But not as much as they probably should have been, given the rally in spot 1.5%. So what we saw there is fixed strike vol firmer. Slightly, you've got the event today. They're not really letting fixed strike vol reset just now. Obviously, post event that we would expect a healthy vol reset to come, as we mentioned in yesterday's daily note. And that's come what may, right? So whatever direction the market decides to take, we do think implied vols will reset lower. And then Asian vols were also firm a little bit here, and commodities vols were very firm. Both oil, nat gas up decently, but even the likes of uranium seeing a vol bid, GDX seeing a vol bid as well. In terms of carry, Nasdaq really the only one in negative carry right now. So we have seen vols kind of creep higher, realize hang in there, and therefore we've got positive carry across the board. Can't say the same thing in commodities, where gold is still in negative and everything else is kind of plus or minus flat. So that's just generally been a trend of commodity vols grinding lower and realized vol ticking higher in commodities, basically. But gold, we do think gold vols are probably susceptible to about a vol or vol and a half of downside back towards that 13 area. But they do look relatively decent value when they get down there. So we don't think it's a bad thing to keep your eye out to maybe scoop up some gold vol if there was a reset post CPI. Skew wise, we saw skew drift a little bit on that rally, but actually what's happening there is you're riding up the curve. So this is a technical thing that happens in vol, where skew, if you do have a material rally in spot, because the shape of the surface is asymmetric, you move to a place on the curve which has flatter skew than we had yesterday when we were at lower spot level. So whilst it looks like skew's coming in, if we look at fixed strike surface again, and we'll do that in a bit, you can see that skew's actually still quite firm. And then dollar-wise, dollar kind of giving a bit back against some of the majors yesterday. But you did see dollar yen higher, as Ueda does seem to be the person who's going to be Kuroda's successor, according to the press in Japan, although it's not official. But markets are kind of taking dollar yen a little bit higher on the back of that right now. Okay, if we jump over to kind of CPI. So we've seen skew go bid into the CPI, right? We've been banging on about this last week. Big data point for the markets, US CPI. And even though the Fed's reaction function seem to be more anchored with labor market data recently, as the market's expectation that this disinflationary trend of the past months was just going to continue. That latest jobs report being such a blowout number, and then the strong ISM services straight after it, and also the fact that used car prices have bounced as well from the chart that we've got in the deck there. Have got investors nervous that we might see inflation rear its head again, right? And might get a bounce in the data. And then if we were to get bounce data, then how does the Fed react to that? We've already seen terminal rates push back up to new highs at around 5.2%, and Fed speakers remain very hawkish. So this is why all that protection buying's come in. Now, the last few CPI prints were generally characterized by right tail hedging, as investors were very underweight still. And therefore they were wanting to buy calls. It looks like the opposite this time around. We've had investors get forced back into the market on the fresh year, strong January, people not really willing to kind of miss the rally, because you can't underperform a market that's rallying 10% a month, right? So we think people forced back into the market and needing to hedge, which is why skew's caught a bid here. We do think because of that, even if this print does come in hot, as many pundits are predicting, because there are some changes to the methodology, seasonal adjustments, weighting factor changes, that we might see the month-on-month change a bit bigger than expected or whatever. We think the compression of vol and skew that is likely to come after the number is out And if we were to get a material move down on a hot print, we think there'll be a ton of hedges that need to be monetized, right? If people are using very short dated options to protect the downside, they also need to monetize those if they get the downside move. And we think that flow that might happen intraday or between now and Friday is likely to create an unwind where dealers may need to cover deltas and it might take the market up again. So we do think a knee-jerk lower on a hot CPI is probably a short-lived thing, and I would not be surprised to see the market rally back again and even close the end of the week higher, even if the CPI came in slightly hotter than expected. So that's my feel based on what I've been seeing in the options flow and the behavioral dynamics around what these short-dated option buyers are going to need to do with their hedges if we were to get that downside adverse move. Okay, and then if we look at that fixed strike surface that I've been talking about, this is the S&P fixed strike surface yesterday and what it did. We were up around 1% in terms of spot. Typically, you would see volatility come down when that happens, but you can see I've got March vols up 30 basis points and relatively unchanged for the at-the-moneys in April and June. We have seen upside get offered here, downside get bid, both in March and April. So we are seeing that fixed strike skew surface continuing to hold a bid as people need that downside protection. And if anything, they're short of that downside stuff. So like I said, those vol dynamics do suggest that there's been a lot of short-dated downside bought in the S&P recently. And it also reinforces, apart from the monetization that we already talked about, it reinforces the Vanna and charm dynamics that you typically see going into OPEX. Okay, so typically into OPEX, as time passes, you have a charm effect. As vol gets hit lower, like we are likely to see post CPI, if the street is short loaded downside and long upside, then that will create dealers needing to cover deltas and buy the market, and that may push the market higher. So we think those dynamics are in place. We think they are probably quite strong this time around due to the flows that we've seen, and therefore do not be surprised to see some supportive option dynamics forcing this market back up, come what may, this week. Okay, and then if we have a look at gold, so no specific trade idea today. It's just I've got my radar looking at gold here. We have been long puts on GLD. We got into those on the 10th of Jan, so we're a little bit early. We missed that last sort of push higher, but we have seen obviously gold come down. We think gold is in a corrective move right now. So we do think the trend is higher in gold. But right now, this corrective move, we think, is going to close out somewhere in this buy zone. So 166 to 169 is kind of the target buy zone where I look to monetize any puts that I've got in GLD and look for bullish expressions to play upside into, later this year, basically. So I wouldn't be going to anything too short dated. It's kind of a structural view that I do think gold is probably in a buy the dip type, that's the right strategy right now for gold. And I'd be looking at potentially getting into some calls or call spreads longer dated if that happens, right? From our volatility dashboard, it also suggests that maybe selling puts, bullish risk reversals might be an okay trade here. Personally, I wouldn't really want to do that because vol levels aren't juicy enough really for me to want to sell a load of puts on gold. I'd rather come in there, wait for vol to reset a bit lower, maybe to go down here. And we can get into some longer dated stuff, which will be on a sensible vol where we can get some leverage to our capital to own some call spreads in GLD. Anyway, that's basically what I'm looking at. CPI is out in 5 minutes now. Good luck out there today. But like I said, my gut is saying buy the dip opportunity is probably coming on a hot CPI. Okay, thanks for listening. See you tomorrow.